Hey guys, what's up? It's Chad. Happy Wednesday, hump day. Hopefully you all are having a great week. So just wanted to get on and talk a little bit about what happened today, especially the Federal Reserve meeting minutes from last month. But first, I just wanted to point out this. The crude oil has made quite a bounce back from its lows at about 40. So it had broken down below 40, and everybody was saying, well, is it going to go down to 35, going down to 30? Well, here we are right back at 47. So crude oil is not dead, just to let you know. All right, but back to the meat of what I wanted to talk about today is the Federal Reserve meeting minutes. So here on your screen, I have up in the right-hand corner, I have the dollar. And then in the bottom right-hand corner, I have the S&P 500. This is SPX. And then here in the bottom left-hand corner is TLT, which is the 20-year bond ETF. So the reason I brought these all up is because they usually react to the Federal Reserve interest rates news. So the minutes said that the members of the Federal Reserve were much closer to hiking interest rates than they were previous. In fact, several members wanted to hike interest rates last month, which to me is great. I would love to see them normalize rates. You know, the economy is doing okay, but we're not at crisis level, and I think they should have risen rates a while ago. Anyway, that being said, how did the markets react? So here's S&P right here, 11 o'clock. See this dip right there, and then it went right back up, and actually ended the day up. Now, is that consistent with a rise in interest rates? Usually not, especially if you consider that they raised the Fed funds rate in December and haven't raised it since. So many people consider this to be a new cycle. So if they start raising again, a lot of people believe that it's basically a new cycle. And what happens with the Federal Reserve rate cycle is when you first raise rates, you'll get a downward move in the markets. A lot of times during the course of raising rates, you will see some increase in markets early on, and then markets will react appropriately and start to pull back because interest rates are supposed to slow the economy, right? So that's pretty easy to understand. But today, even though the Fed is closer to raising rates and may raise either in September or December, the market did not react that way. The market reacted positively and it went up. So let's look at the other rates or other markets. So here's TLT right here, similar story. You would think that if the Fed was going to raise rates, that bond rates would also increase, in coordination to that. But in fact, there was a sharp move downward, and then the TLT moved up. So the TLT move up means rates go down. So that's not very consistent with an upcoming rate rise either. Now let's look at the dollar. So up in the right-hand corner of your screen, there's the dollar. There's a big spike right there, a big spike up, and then a big drop down. So the dollar moves with rates because when the Federal Reserve raises interest rates, bond rates also increase, and foreign money starts to flow to the United States. That's because bonds become better investments, right? If they're paying more, more people want to invest in them, especially with rates overseas being what they are. You know, Germany's 10-year is at minus 0.05%. The United Kingdom, their 10-year is at 0.56%. But in the U.S., our 10-year is at 1.53%, which is much better than in other countries. So if that increases due to the Federal Reserve, then even more money should be flowing into the United States, thereby increasing the price of the dollar. Did that happen? No. The dollar fell today. You can see it right there on your screen. So are all of these markets telegraphing a rise in interest rates? No, absolutely not. They think that the Federal Reserve will not raise rates, which is consistent with a loss of credibility by the Fed. So the Fed has been saying that they're going to raise rates for the last year and a half, really. They did it once in December and then have refused to do it ever since. You know, whether they were waiting for Brexit or whether they're trying to get past the China crash that they had, you know, at the end of last year and early this year. They always seem to have excuses, which is okay. I understand that it's very risky because our economy is not in the greatest position. As you all probably know, our debt levels are super high. Our credit markets are incredibly extended. You know, even though the consumer has deleveraged the mortgage market quite significantly, just take a look at the subprime auto loan markets, or even more significantly, the corporate credit markets. There's a ton of credit that's been extended, and if interest rates start to increase, it could really cause a problem. Or if inflation increases, even without the intervention of the Federal Reserve, it could really cause a really big problem. So I understand that the Federal Reserve is worried and they don't want to raise rates too soon. But at this point, they may have missed their window. And I just wish that they would, you know, either say so, or since they say the economy is doing so well, then raise rates. They should not be waiting until the stock market says, you know, that they can raise rates. Or they should not be waiting for the correct time in the presidential cycle. If they think it's time to raise rates, they should just do it. It's really annoying that they have all this political pressure and, you know, everybody else is trying to look at the numbers because they say they're data dependent. But now they're talking about changing the goal inflation rate. So it's really frustrating. Obviously, none of us are, well, I don't know, maybe somebody's listening from the Fed, but obviously I am not a member of the Federal Reserve. I'm not going to be voting, but it'd be really useful to know that they actually use data in making their decisions. You know, something like the Taylor rule. The Taylor rule is a really interesting idea where it just goes strictly by data and takes the subjectivity out of it. There's no human decision making with rates. It's just based on data, which is really interesting to me anyway. I think it should definitely be considered. If we were going by the Taylor rule, then we would have increased rates a long time ago. So anyway, hopefully my rant is over for now. But you can see exactly by what's on your screen. Are they raising rates? It doesn't look like it, or at least the markets are not expecting it at this point. So anyway, hopefully the rest of your week goes well, and we'll talk to you again. All right, take care. Bye-bye.